right, welcome to episode 4 of Wall Street Journal, your unscheduled yet mostly weekly deep dive into the volatility market. I am your host, Tony Dundas-Luca. We have got a lot to dig into this week because it was a volatile week. We had a lot of events, starting with VIX expiration on Wednesday, then NVIDIA earnings on Wednesday. There was some old stale jobs numbers. We had options expiration on Friday. We had Fed speakers coming out of the woodwork, left, right, and center. Some trying to assure us that we're going to have a rate cut, others saying not so fast. So yeah, the market had a lot to grapple with. And as always, we're going to take a look at how the volatility market responded to all of this throughout the course of the week. So we're going to start with a look at the VIX futures complex, why it's so important, the VIX futures curve in particular, why I track it so closely, what it tells us, how it evolved over the past week. We're then going to spend some time looking at two ways to look at the composition of VIX. They're not they kind of complement each other as opposed to are opposites or whatnot. So there's a very cool new tool that the CBOE released that I want to at least highlight quickly. We're also going to take a look at our fixed strike vol again to see if there was anything interesting that popped up this week. There was one thing, so that'll be cool to take a look at. Then we're going to do a little bit of this week's tweets, the new segment that I started last week. We're going to also take a look at Tales from the Tape. Quick stopover on liquidity, treasury volatility, and then we're going to end with the credit markets. But before we get started, a quick word from the attorneys. Okie dokie, welcome back. So thank you for listening to that. Let's get my face out of the way and dive right into the VIX futures because I think there is a lot to be learned from the VIX futures this week. So I have pulled up here, this is on VIXCentral.com, which is a great resource for keeping an eye on what's going on with the VIX futures curve. So let's just start real quick. Why do I even care about the VIX futures curve? Well, a couple things. I've mentioned this a little bit in the past. The VIX is called the fear gauge. Well, that's all well and good, but I think that kind of dumbs down a little bit what value it adds. I consider it more the heart rate variability of the market. So for you health nerds out there, you'll know what heart rate variability is. For those who are not big health nerds, that's fine. Basically, it's a way for us humans, if you measure your heart rate variability, it's a very good way of telling how recovered you are physically. It can be a good leading indicator of whether something's off in your body, whether you're going to be getting sick soon, or whether you've overtrained. It just gives you, it's a multi-dimensional look at your overall kind of current health. And so I see the VIX complex. So in this case, I'm talking VIX, VVIX, VIX futures, all the broader kind of options market and the underlyings and the derivatives from it. I see that when all pooled together can give you a much more nuanced look at the health of the market. It's not just, is the market fearful or does it feel safe? Is it sick or is it healthy? It gives you kind of a good look at the spectrum. And the VIX futures the VIX futures curve, the term structure, as I refer to it as well, is a great way to get a quick visual on the overall health, at least of the VIX futures market. And the reason the VIX futures market is also important is that's what all of the products are that you trade. If you are trading VIX related products, they are derived from the VIX futures. So specifically, I'm talking about the exchange traded notes, the ETNs like VXX and UVXY. They are constructed of a mix of VIX futures contracts. And throughout the course of a VIX futures contract expiration cycle, the composition of those ETNs changes. So at day one, so this Wednesday when we rolled over and December became the front month future, those ETNs were comprised 100% of December VIX contracts. Well, as we move through the next 28 days, I think it is, of the December VIX expiration cycle, the mix of December contracts to January contracts will slowly shift so it's more weighted towards January. And so that's why throughout the course of the month, you'll hear me talking about which contract I'm most focused on. And usually for the first kind of like, I don't know, 2/3 of the expiration cycle, I'm mostly focused on the front month. So in this case, it's December. But as we get later into the cycle, I'll shift and I'll focus more on the second month because it's starting to be weighted more heavily into the ETNs. And also because the closer that the front month gets to expiration, the closer it's just going to move along with VIX. Now, sometimes that's very good if you're going to be putting on a VIX futures trade and it's going to be a very short-term hold and you're expecting the VIX to either pop or come down and you're near the end of that expiration cycle, and then you can be pretty sure that that contract's going to chase VIX pretty quickly. So sometimes I'll use the front month when it's near expiration if I see something very short-term that I want to take advantage of. But other than that, a lot can be learned from the VIX futures, which is why I'm always looking at them. So let's dive right in and see what we are looking at as far as the VIX futures curve goes. And as you can see, this is the blue line. This is from last Friday, November 14th. The green line is from this Wednesday, November 19th. And this orange line at the top is from Friday, November 21st. So quick look, what we can see is the line continually moved higher from last Friday to this past Friday. As you can see, last Friday we had this blue dot over here. That was the November contract. It has since expired, which is why we do not see it on the green and the orange lines. So as we see, the blue line moved up from Friday to Wednesday to Friday. So generally speaking, that is telling us that volatility is moving higher. The market is becoming a little less settled. And just as importantly, the curve actually flattened out. So you can see that this was steeper. This blue line is steeper here than this green line and this orange line. They flattened out a little bit. And this is a little bit, I wouldn't say this is going to say it's a little bit misleading, but it's not. It's actually, the scale is pretty good. So you can see it's relatively flat this week, and I'm going to show you a different representation where you can see this a little bit more clearly. But another takeaway is that we are still holding contango, and the contango just means that the curve is upward sloping from left to right. Contango being upward sloping, a curve that's upward sloping in contango is a sign of a healthier, less stressed market. The fact that it has flattened out as much as it has is certainly a warning sign. And so let's jump to that. So I have screenshots of the VIX curve from Wednesday, and I posted this on Twitter. So this was on Wednesday. You can see the blue line is still upward sloping. You can see between December and January contract, 20.95 and 21.95, there was one vol point between the two. And then from there, it kind of flattened out further. What's important is this green dotted line, which is the VIX, closed Wednesday, or this was Wednesday morning, was already above the December and January contracts and basically even with February and March. It was still below the further out contracts, but this is concerning. More concerning is when this blue curve is either flat or inverted, and inverted meaning it's downward sloping from left to right. So in this case, it wasn't quite there yet, but this was starting to look, this was concerning because once the VIX gets above these contracts, they start to feel pulled higher towards it. Now, because it is the beginning, this was Wednesday morning, right when December became the front month future. Because it's the beginning of the December expiration cycle, it's not going to track VIX very closely. I mean, obviously, if VIX is jumping, it's going to move up, but it's not going to move one for one with it. It'll start moving one for one with it when it's a couple days away from expiration. But this far out, it'll kind of let VIX do its thing, but it will generally move in the same direction as VIX. So if VIX does keep climbing, it will lift higher. And the concern is that the front of the curve will move more than the back of the curve or further out. And as the front of the curve is getting pulled up higher faster than the further back curves, contracts, the curve will flatten out and then eventually invert. So that's what I was on the lookout for on Wednesday. And so I'm now going to pull up Fridays. And so between Wednesday and Friday, you can see the curve looks even different. So here we have the curve basically board flat. There is like very little curve to it. The lowest contract is the December contract, still at 22.8. The highest contract is at 23.25 in February. So that is tiny. That's only 0.45 vol points between the entire height of the curve down to its lowest point. So as you can see, this board is very flat. We can also see on Friday morning the VIX was above the entire term structure, and then this was actually Friday, I think at the close. Either way, we did close the week in slight contango at the front of the curve. So the December contract did close the week below the January contract. We're going to look a little bit later on at when we get to tails from the tape at what was going on in the December contract on Thursday and Friday and why that was important. But this right here, this is a concerning term structure. And if December had closed above January on Friday, I would have considered putting on a long volatility position. Now, the good thing, and I did mention this on Twitter, and I use good kind of loosely here, the curve is already in the 20s. So you can see that it's already basically everything's at 23 or above. And so I'd say that's kind of the low to mid 20s. The good thing is that when the board inverts, so moves into backwardation, and it's already in the 20s, that's less concerning than when it inverts and it's down in the teens. Because, and for those of you who've been watching volatility stuff for a while will remember Volmageddon back in early of 2018. The VIX term structure was very low. It was in the teens. And then kind of out of the blue, not really, if you watch this stuff closely, the curve had been slowly flattening. And then for those who weren't really paying attention, the curve actually inverted. So it flipped into backwardation kind of subtly. And I think it was going into the weekend. I can't remember now, but it was really low. And when the board inverts and it's really low from a low volatility standpoint, the move higher can be explosive because the market is basically sleepwalking at that point. Whereas in this case, the market's already on edge. It's already up, on its toes, like looking for danger. And so with volatility, with the VIX futures is already up into the kind of low to mid 20s. If it inverts, that's not a great sign, but it's going to take, I refer to it as fuel. It's going to take a lot of fuel to keep the volatility market climbing higher. So this is concerning. It would be a lot more concerning if, the VIX futures curve was like at 17 or 15. The fact that it's already in the 20s is a little less concerning because even if it flips, it's going to need the S&P to start going like plunging on big daily moves down lower. I am not saying that can't happen. Clearly, there's a lot of fuel out there, but generally speaking, I would rather see the board invert in the mid 20s than I would in the mid-teens. So at this point, not a great look. And when we get into tails for the tape, we'll see other reasons why it's not a great look. But I hope that gives you kind of a good idea of why I watch the term structure so closely and why I think it's a very good way to kind of gauge the overall health and resiliency of the volatility market, which in turn gives you a good read on the health and resiliency of the equity markets. And additionally, volatility markets, they don't, even just the VIX, which is based off the S&P options, like the traders in those marketplaces, they're not just watching equities. They're also paying attention to the treasury market and foreign exchange markets. And so when they see stress, when those traders see stress in other parts of the market, they'll respond in the VIX as well, in VIX futures and in S&P 500 options and VIX options. And so it's not like the VIX only captures concern in equities. It also captures concern in other parts of the markets when it's relevant. And that's not always the case. Like there are plenty of times when the market just doesn't really care what's going on in the dollar or other foreign exchanges and other currencies. And there's other times when it really cares about what's going on in the treasury market. Right now is one of those periods where it's mostly focused on on what's going on in the equity market. Now, if the treasury market starts getting a little crazy, then we would certainly start to see the volatility market respond to that. So again, this is more just painting the picture of like why I care so much about the VIX complex and why I think it can be such a useful tool to really better understanding the general health of the market and not just the equity market. Okay, so with that taken care of, let me see here. I want to go take a look at, sorry, this video is in the way. I can't see what I want to look at next. Okay, The next thing I wanted to take a look at actually is some VIX levels. And I want to preface this by saying I do not practice technical analysis on the VIX. The VIX is a calculation. Technical analysis is the basis, is that it's derived on human emotion and behavior. The VIX is just a calculation, although underneath that calculation, there are people making trades. But that said, I do think there is value in watching that there are certain levels, for whatever reason, that tend to be important. And so recently I had been highlighting, and we're now looking at the daily chart of the VIX. These black horizontal lines are levels that I have identified as being relatively sticky. And so I've been highlighting this level right here, which is the 2250 level. I've been highlighting the 25 level because I'd like to see what VIX is doing around those levels. And the same is true for VVIX, which is this down here. So we see this down here. This between yellow and green is the 117 level. This line right here is the 125 level. Up here is the 137 level. So they sound like very specific levels. And to some degree, I guess they kind of are, because I'm choosing like 117 versus whatever, 150. But it's more like kind of 115 to 120 or 135 to 140. I'm just generally looking to see what's going on at those levels because for whatever reason, VIX, VVIX, VIX futures, they tend to kind of cluster and get sticky around these levels. So anyways, as you can see here, 2250 on the VIX was important on the way up during the kind of reemergence of China tariff issues. 25, we kind of paused. And then way up here at 28, we pushed up to. And then coming back more recently, again, we got up to 2250, pulled back, tested it again, got above it, pulled back, got up to 25, pushed through it. Couldn't quite get to 28. And the same is on VVIX here. We got kind of up to this level, tested, came up, came down, pushed up. What I look for, and I'm going to get to this a little bit later too, is, and this was a big theme this week and what I was tweeting about or posting on social media and on Substack, was relative moves. And so I'm looking to see how, it's not just the levels themselves, but but how is the VIX and the VVIX responding to those levels relative to how it responded to those levels in the past? So the fact that like VVIX didn't quite get to its highs from mid-October, whereas we'll see later VIX futures did, that was important to me. And then earlier in the week, I was watching how VIX and VVIX were responding to their levels relative to how the S&P was responding to its previous levels. So this is just kind of a quick look at like why I'm looking at these levels and why I think they can be important. I don't base trades off them really per se, especially the specific levels, but it does when I'm looking at relative action, that will inform how I make trades. So yes, that was one thing. And then the other thing I wanted to point out, and I talk about over and under vixing a fair amount. And for those who need a refresher, if you look at the historical relationship between the S&P and the VIX, you can basically generate a regression that tells you kind of how the VIX should move relative to an S&P move. And so if the VIX moves more than the S&P move suggests that it should, I consider that over-vixing. If the VIX moves less relative to moving the S&P, that's under-vixing. And so I look at how in individual sessions throughout the course of the session, are we under-vixing? Are we over-vixing? Are we kind of appropriately vixing? And then I also look at kind of cumulatively. I have a little spreadsheet that adds up over the past 2 weeks, the cumulative over and under vixing, because I can get some sense of like, generally speaking, what kind of like over under vixing regime are we in? And so if you look here on this, this is an S&P chart up here, and then down here is my calculation of over under vixing. Anything above 2.5 is the greens. That's saying you're really over vixing, and anything in the red is below negative 2.5. That's saying you're very much under vixing. So as you can see, most of you have been kind of chunking along right around like in this white band, which is kind of the appropriate amount of vixing. But what did stand out to me was that we over-vixed most of the week, and that led to the cumulative over-vixing of hitting the 90th percentile over the past year. So on Friday, what then happened is we actually under-vixed. You can see that here where this black line dropped considerably lower. So I wasn't totally shocked to see that happen, because when you have large cumulative over-vixing or large cumulative under-vixing, sometimes, usually, I don't know how you want to quantify it, you'll get a reaction that kind of evens that out. So this is a very busy spreadsheet. You've probably seen, if you've watched these videos before, you have seen it. But what I want to highlight is right here, these three rows. And so this was this week: Monday, Tuesday, Wednesday, Thursday, Friday. And you can see we over-vixed by 1.2, 108. We kind of slightly under-vixed on Wednesday, over-vixed again on Thursday, and then very much under-vixed on Friday. And this right here, this middle row, is the cumulative. And so it's looking back 10 sessions. So when we got into Monday, see, all this yellow means it was kind of a normal over-under-vixing environment. So that's kind of a steady, VIX is kind of doing what you think it would environment. Well, then on Tuesday, the cumulative pushed us into green, which is telling me that we're starting to like cumulatively over VIX. And this bottom row right here is the percentile on a 1 year look back. So we jumped from 67 to 82, 82. Thursday, we jumped up to 90. Once we're getting into the 80s and 90s, I start to think like, okay, we're going to have a response the other way. And that's what happened on Friday. So we under VIXed on Friday, meaning that the S&P, which was up 1%, VIX was down 3 vol points. And so that ended up being, the calculation tells us we under VIX by 1.7. So the VIX dropped more than a 1% increase in the S&P 500 would generally suggest the VIX should move down. So move down more than you'd expect. So that over-under VIXing dynamic for me can be a good way to kind of set expectations as to whether a VIX move or an S&P move kind of makes sense in a broader context of over and under VIXing. So it's a tool I use. I find it useful. Again, it's not something I really base trades on, but it's really more for context. And for me, context is really like extremely important in just judging the overall health and mood of the market. All right, so let's take a look at, sorry, I need to move this. Let's take a look at VIX components. So if you've watched these videos before, you are probably familiar with this. This is one way to look at kind of the components of the volatility market. It looks at this orange line up here is the VIX EQ. That is individual stock volatility. So basically the components of the S&P 500. The pink line is the dispersion index. So that's a way to measure index volatility relative to index constituent volatility. The blue line is 1 month implied correlations, and the black line is the VIX. So really just a couple things I want to highlight here. As we can see, implied correlations, and I was highlighting this weeks ago, had gotten very low. When they get very low, they tend to go higher. And when they tend to go higher, that's usually because you're starting to get volatility pick up, generally speaking, in the market. And as you can see, as they pushed higher, so did the VIX. At the same time, this is when we were kind of getting into and through earnings season, the individual stock volatility, so this orange line started pressing lower, and that, as individual stock volatility moves lower and index volatility moves higher, that moves this dispersion index lower. So it made sense that this orange and pink line were moving lower together as the blue and the black lines moved together higher. Now, what we saw this week is they all started moving higher together. So index volatility was moving higher, index component volatility was moving higher, implied correlations were moving higher. So that's kind of like a basket of like not great stuff, because everything's starting to move a lot. Now, this middle pane down here shows is the difference between individual stock volatility and index volatility. So when this is moving down, it's telling you that the index volatility is outperforming constituent volatility. So we really saw that start to happen in late October. After basically 2 months of individual stock volatility outperforming index volatility, now we have index volatility outperforming individual stock volatility. And that's, this kind of ebb and flow, this cycle, is pretty normal. You can see most of the time it stays in this range. It then broke out and now it's moved back into the range. So generally speaking, like this kind of looks normal to me. I am certainly keeping an eye on implied correlations and all of these factors because they can be very informative as far as what is going on beneath the surface. So yeah, the fact that we had all of them moving higher this week is just another thing that I find, mildly concerning. Okay, so moving on, I would like to now do just a quick look at a new tool. Sorry, where are my bookmarks? The CBOE released a paper back this summer about their decomposition and how it was a paper that explained what are the different factors that go into the VIX calculation and what's contributing to the overall VIX move. And they said, at some point in the fall, we're going to actually release a tool. And so they released the tool, and it is very cool. And so pretty much what you do is you can put in 2 dates. So I'm just going to do Thursday the 20th to Friday the 21st. So this is this past Thursday into Friday. And you click compute, and it tells you what happened. And so the green line down here, so this is S&P. On the bottom axis is the strike price, and on the y-axis is implied volatility. So these are the implied volatility curves for those 2 days. So the green curve is from Friday, the black curve is from Thursday. So overall, you can see that the curve itself came down a little bit. The black line moved down to the green line. And then over here, it tells you what contributed to the move. And so on the 20th, we had the S&P close at 65.38. On the 21st, it closed at 66.02, basically 66.03. The VIX went from 26.42 to 23.43. So the change in the VIX was 2.99 points. So basically the VIX lost 3 points. And then what they do down here is they explain what contributed to that 3-point drop. And so there's sticky strike, parallel shift, put skew, call skew, downside convexity, and upside convexity. I'm not going to go through in detail every single one of these because it'll take a long time. But you could, if you want the paper, just Google CBOE VIX decomposition, it'll pop up. I've read it a couple times because I find this stuff kind of fascinating. I'm still kind of wrapping my head around the sticky strike. It's kind of like the fixed strike, but every time I try to do the calculation myself, I can't get it right. But basically it's this is looking at the sticky strike is kind of the change in fixed strike volatility, how the market was already assigning a volatility change. So in this case, on Thursday versus Friday, as of Thursday's data, how is it calculating implied volatility for where the market moved up into on Friday? Parallel shift is just how did the entire curve move together? Put skew and call skew, if I remember correctly, you're kind of looking at this 25 or 30 delta to 40 delta range, just kind of generally where people tend to hedge using options is in this kind of 20 to 40 delta range. And so the put skew and the call skew is trying to capture that. The downside convexity and the upside convexity, those are looking at the wings. So that's looking, I think it's kind of like the maybe 15 to 5 delta. So way deep out of the money puts and calls. So on the downside convexity, it's the puts, upside convexity, it's the calls. So basically what this is showing is fixed strike vol came down, then the parallel shift, the whole curve came down, put skew. So this is that kind of out of the money or kind of near the money. Puts, those got sold, which is why I see a negative here. The call skew is basically flat, came down a little bit. So those kind of 30 delta calls, the demand for those was soft. Downside convexity, so puts, so the deep out of the money puts, actually there was a bid there. So you can see it was positive by 0.22, and yet upside calls got absolutely smashed. We'll say absolutely smashed, that's dramatic. Upside calls got smacked down by 0.44 vol points. So you add those up together and you get to why the VIX moved by 2.99 on Friday. So anyways, I think this stuff is pretty fascinating. I'm basically looking at it every day now and I'm kind of comparing it to what my fixed strike vol was telling me and seeing if I'm really kind of just testing to see if my fixed strike vol little matrix that I look at is even worth a damn. And so far it's been, it's been informative, and it tells me that it's worthwhile that I keep looking at my fixed strike vol stuff. So anyways, if you take a look at this and you have any questions or comments, certainly let me know. I can't promise I'm going to have any great insights. I will probably just refer you to the paper. But anyways, it's cool that the CBOE puts this stuff out here because I think it could be really informative. But anyway, speaking of fixed strike vol, let's pull up my fixed strike vol matrix. So those of you who have been watching these videos are going to see this somewhat familiar. So the purple line up here on the chart is the skew of fixed strike vol, and then the other measures, we're not going to pay attention to those. So what I was looking at this week, and really there's only one thing I wanted to highlight that I thought was somewhat interesting. So this is what I was looking at this week. So I was looking at the 69.25 call, the 65.70 put. As of Friday the 14th, the call's IV was 14.56, the put's IV was 18.80. So from Friday to Friday, the call IV went from 14.56 to 14.77. So relatively unchanged. The put IV went from 18.8 to 19.5. So there was overall a bid to the puts and relatively flat demand for the calls. But what was interesting was on Wednesday. And so if you remember, Wednesday morning was the VIX futures expiration. And then we had, after the market, we had NVIDIA earnings. And what was interesting was Wednesday after the close, which is when I take these, when I take my measures, the call side. So on Tuesday, the implied volatility of the 69.25 call was 15.37. At the close on Wednesday, it had jumped to 16.04. Okay, that's kind of normal, not a huge change. But what was really interesting was the put side. The 65.70 put went from 21.54 to 18.66. So on this one specific strike, the demand for the puts went way down. Yet the demand for the calls went up. And so what that did, you can see here, this red box of 1.16, it smashed the skew. The skew went from 1.4, which is relatively high, that's why it's green, to 1.16, which is relatively low. So what I find interesting about this is that people bought a lot of calls, or there was a lot of demand for calls ahead of NVIDIA earnings. People were bracing for NVIDIA to outperform, or at least to have a strong reaction. And they actually got that. So the next morning, after the market, when NVIDIA released, futures shot up higher. Volatility futures got smacked. And then at the open on Thursday, we had a really strong open. But then we had the market reversed really strongly and dumped like crazy on Thursday. I have a feeling that part of that may have been because people loaded up on calls ahead of time. The next morning on Thursday, the market rips. Rather than sit around and wait, they monetized those calls, meaning they took their profits. They closed out all those calls. And as they were closing out all those calls, all that selling of the calls actually started putting, because of the market makers who were on the other side of those trades, it put a lot of downward pressure on the market itself, which contributed to the market rolling over. And then it just started this like negative feedback loop to the downside. So anyways, that stood out to me on the fixed strike vol front. I'm actually curious. So I want to look at the 18th to the 19th. I don't remember. I'm going to pull up the 18th to the 19th on the VIX composition or decomposition. Because remember what I was saying, so this is interesting. So this is a little bit different. So this is saying, so the VIX came down, but it's saying it was on the call side. Both of the call sides showed a drop off of implied volatility and the put side showed an increase. So interesting. So that's different than what I saw. So again, this is kind of the limitations of me just looking at like one strike throughout the course of the day, although this is somewhat specific too. But anyways, I won't say hoping, but I was thinking this might have shown like a similar story. But anyways, that doesn't mean I don't believe in what I just said about the potential bid for those calls and then the release of those calls the next day after the open, contributing to the sell-off on Thursday. I still think that could be a valid hypothesis. Okay, next section. Let's jump into this week's tweets. And so one thing I really want to, the highlight here, the main theme from this week's tweets this week was relative moves. And specifically, I'm looking at the VIX, the VVIX, and the S&P. And so on Monday, we had a very strong open. And give me 1 second. The NASDAQ and the semis, so the semiconductors opened very strong. And so that was pushing the market higher. That was pushing the VIX lower. And yet, once the market rolled over, the VIX and the VVIX went to new highs on this move, even though the S&P hadn't gone to a new low. So let's look at the S&P first. So this candle right here is Friday the 14th. This candle here is Monday the 17th. So what I'm looking at here is the low on Monday was 66.38.90. So just let's call it 66.40. And I'm comparing it to the lows back on October 10th. So the low back on October 10th was 65.50. So 65.50 versus 66.40. So it was at 90 points difference. So the S&P was 90 points higher on Monday versus October 10th. Yet if we look at the VIX, so Monday the 17th, we got to a high of 23.44. Yet on October 10th, we got to a high of 22.44. So what was that? Basically, the VIX was one vol point higher, while the S&P was 90 points also higher. The S&P was 90 points. The low of the S&P was 90 points higher than the low from the 10th, and the VIX was also higher. And then we also saw that on the VVIX. The VVIX on Monday, its high was close to 119. Yet on the 10th, its high was around 118, a little over 118. So again, it's subtle. It's like less than one vol point between the high on the 10th and the high on the 17th and VIX and VVIX. But those little subtleties I think are important, because what it was saying is that even as the S&P was moving lower, but not quite as low, the volatility market was more sensitive. So I'm always looking to see, is the volatility market becoming increasingly or decreasingly sensitive to moves in the S&P? Now, granted, I was comparing, October 10th to November 17th. So that's a big, it's almost a month. But I still find those things to be important. I also I watch these things on a day-to-day basis as well. Because they can give you, what I'm always really looking for is, like I was just saying, is the VIX or the VIX complex, is it becoming more sensitive or less sensitive to selling or buying in the S&P? And so this stood out to me as an important divergence. Okay, so then on Tuesday, and this is where I'm kind of tying this together. So on Monday, we were seeing the volatility market was increasingly sensitive to selling, even though the selling wasn't getting worse. Well, then on Tuesday, the S&P did press to new lows. So we see this here, this pink candle. It did press to new lows. And that really got the volatility market moving. So we went from here on Monday up to here on Tuesday, and we pressed above this sticky level of 25. And we also, the VVIX keep pressing higher. So Monday, we get these early signs that the volatility market is more sensitive than it has been. Tuesday, we see a follow through. And then jumping ahead on Thursday and Friday, we get kind of the opposite. So on Thursday and Friday, what we see, and I'm going to do this looking at, so this right now, this is the December VIX futures contract, and this down here is the VVIX. So again, we're looking at kind of mid-October. So this is October down here. We're looking at October 16th and 17th. Up here, we're looking at October 16th and 17th. As you can see, this is the December VIX futures contract between the 17th and Friday, or this was even, so really I'm looking out to kind of Thursday and Friday. Thursday and Friday, we were pushing to new highs on the VIX futures contract, yet down here, VVIX has not yet hit the highs from the 16th and 17th. So I wasn't too surprised, and this was happening on Thursday, I wasn't too surprised that on Friday, the volatility market really kind of lost its bid a little bit. And that happened as the S&P started to rally. And so we saw volatility come off very quickly. So the big picture here is Monday, we got some early signs that the volatility market was more sensitive. By Thursday, we were seeing that it was actually less sensitive, just by looking at the VVIX. And that was enough to say, okay, maybe this move is starting to lose some steam. So what I'm on the lookout for now is like follow through. Like, does the VVIX or VIX futures, do they start to kind of underperform? And we saw that again, going back to the over-under vixing that we show here, we saw significant under-vixing on Friday, which some of that Thursday action kind of hinted that like something's kind of going on here. The volatility market looks like it's losing a little bit of its momentum, which I say we did. Okay, and then the other thing that I was highlighting on my tweets was that contango continued to hold, even though the VIX, spot VIX was pushing over the VIX curve. So that was what I was highlighting here on Wednesday. And then on Friday, we got, yes, very slight contango. But again, going back to what I was saying here and just wrapping this up quickly, on Twitter, I was just highlighting like, yeah, it's not pretty. It's not good. We don't want to see this, but at least contango is holding. And the fact that it's contango and the fact that the board is already in the 20s is actually kind of a good sign. I'm saying, where did I actually? Yeah. So I wrote that. I think this was on Friday. I said, the good news is that the board inverting like this is, even if it happens in the 20s, like that's actually kind of better. So anyways, that was this week in tweets. And I think the last thing I wanted to show you and get into was, not the last thing, but the last part of this this section, was Tales from the Tape. And so what I wanted to highlight on Tales from the Tape is I want to look at Thursday and Friday in the S&P futures and the December VIX contract. So going back to this is the daily chart of the S&P futures, the ES mini. So even on here, I do highlight levels. And again, I put weight in these levels, but I don't put an excessive amount of weight. They just tend to be areas where price in the past has shown congestion or stickiness. And so what I'm looking for is how is price. It's not that I find these levels are like the holy grail. It's just I want to see how does price and volume act around those levels. And so, on Thursday, which is this big red candle here, remember Wednesday we had NVIDIA earnings after the close. The market ripped. S&P got up into this level. Now I'm going to zoom into an intraday. So these are 1 hour charts. So between this vertical gray dotted line and this one, this is Thursday, and over here is Friday. So right over here is the end of the day, Wednesday. This was like when NVIDIA earnings came out. We can see the S&P futures shot up. It was on pretty light volume. So we closed decently strong with volume, but if you look, this had a long upper wick. You can see this black line right here is one of those levels that I had highlighted. It happens to be at 66.65. Up here is another one, 67.55. And as you can see, we're kind of stuck around this level on Wednesday. And then at the close, we closed below it, but then NVIDIA earnings came out and we shot higher. And then after the close, the market kind of crawled higher, but then it went to sleep. And it kind of got stuck right below this level here. Well, as we moved through the night into Thursday, volume started to pick up. This was 6 a.m. Thursday morning, so right before the cash open. You see we punch higher. So the market's opening strong, but it's opening strong on like decent but not great volume. And like that is very important to me. So it's trying to break out above this sticky level, but it's doing so on pretty light volume, which to me just says like there's not actual real massive demand here. Well, lo and behold, it starts to roll over and then the volume comes in. So look at this candle right here. So this is 8 a.m., the 8 a.m. hour on Thursday. Huge volume, big selling, and it pushes us way down lower. This blue line and this blue line and this red dotted line, that is a volume profile. So this is looking back at a volume profile basically for this chart. And the red dotted line highlights where the price level where the most volume has traded during this time period. So on this chart, this level right here, which it just so happens, and it could just be coincidence. Again, I'm not trying to like overstate the importance of this level, but this red dotted line is called the point of control. It's the price level where the most volume has traded. It happened to basically perfectly align with this 66.65 level. I did not do that myself. It just happens to show up. between the two blue lines, that's where 70% of the volume during this time period has actually taken place. So usually price stays within those bands. And as you can see, even looking back into last week, price got up to the blue line, moved down, got to the point of control, moved back up to the blue line, came down to the lower blue line, came back up. So Thursday, we get this huge sell-off on big volume. So that's not a great sign. It moves away from the point of control. It moves away from this level, hits the lower area down here where volume really was drying up, bounces overnight on Friday, kind of doing nothing. But then you start getting these long lower wicks. Now, granted, this was the overnight session. So this is Asia. This is the European hours. And then we get close to, this is 6 a.m. right here on the Friday open. Light selling volume. So it tries to come down. It tries again to come down during the first hour. We did get a good amount of volume in that in the 7 o'clock hour, but then we got a pop. Now, what I will say is this was a big, powerful up candle, but the volume wasn't great. I would expect if this was really going to be a move higher, you would see more volume come in. This volume should have been bigger than this volume. It should be statement volume that buyers are here. And all that happens is we get back to this level. We get back to this level and then we start printing these long upper wicks, which shows that demand's kind of waning. We're really struggling at this level. Volume starts to really dry up. And then the most meaningful last two candles of the day, we have mostly, this volume right here, this black bar volume on a sell-off candle was higher than the buying volume. And then the final candle of the day at 1 o'clock was tiny little up candle with tiny little volume. So I gotta say, this price action at the end of the day on Friday, was not very inspiring. And so we can look at I'll call it the kind of opposite. We'll look at the December VIX futures contract. We'll go through this more quickly, but this is kind of the opposite of the S&P. You can see this is Thursday, the Thursday open. This is after NVIDIA earnings on Wednesday. Volatility starts to get smacked down over the course of the night on Thursday into the Thursday open. We sell off and then wham. As remember, this is the opposite. Thursday open on the equity side, the equity sold off. VIX futures on the equity open, on the cash open, shot higher on big volume. You can see this big buying volume here. And this is, again, I'm just highlighting, this was a sticky level. This is around 1965, and there's another sticky level up here at 2130. Again, I'm not saying they're special. This just happens to be where there's congestion of price. We bounce off it, big volume comes in, spikes us up. Now here I was highlighting this red line. If you remember, this was the higher high here. If we could see VVIX here, we would see the VVIX was a lower high. And then during the overnight session on Friday kind of goes nowhere. Attempts to go higher on the cash open. We got big volume at the 6 a.m. and the 7 a.m., especially the 7 a.m. But it was important. We had a kind of a long upper wick here. So those buyers of volatility just couldn't keep it going. And then we got decent volume after that for the rest of the day as we sold off. And then going into the close, we got, looks like basically the biggest candle on volume wise of the day. It was a down candle. But I will say the size of the actual price candle was relatively low, and we had a lower wick down here, and we couldn't get back below this sticky level. So as much as it was constructive to see big selling volatility, selling volume come into the VIX futures into the close, I don't like the fact that the candle itself wasn't that convincing, and I don't like that I didn't get below this sticky level. So I would say going into the weekend, I'm feeling kind of pretty cautious. I wasn't in love with the close there. And anyway, so that's kind of where I'm coming out overall, that things still don't look great. Okay, last couple things. This is the book of depth of book by the CME of those the same ES mini futures. So as you can see, between this was last week and this was this week, we can see liquidity dropped off. We can see bid-ask spreads widened. So another indication that things aren't great right now. So the market is liquidity starting to leave. When liquidity drains, the market gets thinner. Things tend to move more and more and more, or faster, and you can have kind of disconnects and disjointing price action. So don't love the look of that. We are going to we're going to follow up on what we talked about last week with Treasury volatility. So we're going to look at the MOVE index. What did the MOVE index do over the course of the week? Turn this off, turn this off, turn this off. Okay, so down here in the bottom pane is the MOVE index. If you remember, the creator of the MOVE index, Harley Bassman, has said between 120, this line, and 80 is normal. As you can see, we've been below 180, we've been below 80 for a while now, basically for a couple months. Low volatility is not a bad thing. Low volatility can feed on itself and remain low, but we're watching to see how does it respond if it starts to climb, which it has been climbing. This week it actually dropped a little bit. It got to that 80 level last week and kind of pulled back now. If it gets back into the normal range, again, that's normal. We should expect it to get back to that normal range at some point. But we want to watch is like, how does it get into that range? Does it get into that range violently? Does it then blow through the range and like get to the other side and then pop out the other side? That would be worrisome. Right now, Treasury market volatility is low and in control, so I don't see anything here that we should really be too worried about, but it's certainly something I'm keeping a watch on. And the last thing I want to follow up on, this is something we've been looking at as well, is the correlation between high yield credit spreads and the S&P 500, because it gave us a pretty good heads up that something was amiss. So, quick refresher, this top pane is high yield credit spreads. So when these candles are moving higher, that's showing that spreads are widening. Widening of spreads is an indication of market stress. And so keep in mind, credit spreads in general are very low or very tight. So they are still healthy and tight. I'm not trying to sound some alarm bells, but they are climbing higher. Usually, the S&P 500 and the credit spreads are negatively correlated. So as spreads are going down, i.e. tightening, the S&P generally is moving higher because it's at the credit spreads being tight, sign of market health, S&P 500 is going higher, both signs of market health. So as one's going down, the other one's going up, means correlations should be generally negative, which you can see here. They're almost always down here at negative, below, close to -1. This black line is pretty much at the 0 level. I should probably just make it 0. So even when these things are more correlated, they're barely getting to positively correlated. We saw back here, we got to actually 0.8 correlation. So that was happening because credit spreads were going up here while the S&P was going up here. Well, recently, as the S&P was going up, we did see credit spreads start to go up and widen here, which is what pressed this correlation up to nearly 0. So this was something I've been flagging. We now see credit spreads are continuing to widen while the S&P is selling off. So this correlation is starting to drop again. So it's starting to kind of normalize. But the fact that this credit market was kind of giving us this little whisper, like something's kind of off here, and what captured it was this 10-week correlation between the two. It was, ended up being a prescient signal to be keeping an eye on. So I'm showing that not just like the toot my horn or anything. It's just something I watch, but these little things can be very important. And, generally speaking, the reason I spend all this time looking at the volatility market and all these other markets that I discuss is because I'm looking for any advantage I can find, because I'm not a super sophisticated, hedge fund or, have access to, the most powerful, up-to-date data in real time and analysts, and I'm looking for any edge I can find to help me gain a little bit of an understanding of what's happening in markets. So I'm always looking for just kind of subtle hints, and I find the volatility market and some of these other relationships can be very powerful. So anyways, I'm going to leave it at that. Thank you for watching. I really appreciate the support. To all of you Macro Ops community folks who are joining, thank you. Thanks again to the Macro Ops team for collaborating on this. The Macro Ops team has been pushing these videos on YouTube. I will include a link to the Macro Ops YouTube page in this Substack notes. So you can find these videos if you prefer to watch them. You can now watch them on YouTube. They will usually get posted. I think I post on Sunday on Substack. I think they usually try to get them out Sunday or Monday as well. So anyways, if you don't like watching these in the Substack app or the Substack platform, then you prefer YouTube, they are available on YouTube. It's just usually with a little bit of a delay. So anyways, with all that said, thank you guys so much for watching. I really appreciate it. You can find me at VIX Signals, at Vol Street J, on Twitter or X. You can find me at The Free Dominion on Substack, although I think most of you are already there. And yeah, that's it. Let me know if you have any questions or comments, and we will see you guys next week. Bye-bye.